because we always do this at the end of the event and not the beginning of the event. And so it's important to thank AWS and Fannie Mae and so many other people who make this event possible. So we're going to kick things off immediately, right into a discussion on regulatory policy. I want to welcome the chairman of the CFTC, Rostin Behnam, to the stage right now, and we are going to dive into that agency's work and how it covers an ambit of financial technology. So, Rostin Behnam. All right. Yeah. Oh, I guess you can sit here. I'll just here. Okay. Chairman, welcome back. You have made it here so often as a supporter of this event, and we really appreciate it. You've now been in office now for just about 4 years. Yep. Before we sort of hop into the immediate issues that you're working through, maybe a comment or two on really, as you make regulatory policy, what's kind of surprised you, or what's been a kind of a highlight in your chairmanship as you sort of pivot to the issues facing the agency right now?
Chris, first of all, good to be here again. Wonderful conference, as always. I don't know, when I think back about the past 4 years, it's been a lot's going on, right? Like I got into the job and we were on the, call it, back end of COVID, right? And I think for organizations, there was a lot going on. There still is a lot going on, but even just the most basic thing of getting people back to work and how markets were going to react and how did they react to that event. And we obviously saw huge impacts on physical commodity markets, but on interest rates, on credit, on FX, and just the global macroeconomic picture. And then as times moved on, you know, we had Russia invade Ukraine. We're dealing with Middle East issues. Again, huge impacts on commodity markets, bigger macroeconomic issues. And I think one takeaway was the resilience of the financial system. A lot of fiscal policy change, a lot of stimulus, obviously, but a lot of regulatory reaction, both from the market regulators, the prudential regulators, and of course the central banks across the globe. So stabilizing effects, but a lot of coordinated, intentional action by lawmakers, by regulators to address these, you know, what we call once in 100-year crises, but very unique crises that have had huge impacts on all of us as retail consumers, as citizens, social issues, and everything in between. So, you know, the arc of 2008, the financial crisis, Dodd-Frank and the G7 reforms, and these events that have happened since, I think being in this position, observing all of these events, and this is not to even speak about, which I'm sure we'll talk about, you know, fintech, crypto, a number of cyber events, right? Ion derivatives, which had a direct impact on us, ICBC, to an extent CrowdStrike, which I know is more of a software, but like third-party vendors. So you expect these things to happen in any tenure. This is life. This is the responsibility of the job. But as I start to reflect on the 4 years as we're turning towards 2025, a lot of interesting things. But I would say, you know, one word answer is resilience.
You know, just even listening to that list, it's
tiring.
It makes me tired. Yeah. No, but it's very impressive, and it also shows how the agency has grown, and frankly, how the range of issues facing the agency seems to expand. Yep. Even as its mandate remains the same, the scope of its responsibilities seems to always grow. You know, I don't know if you've noticed, but there are some elections going on around town, which has also brought some attention to your agency, particularly as it pertains to election contracts and prediction markets here in the United States. I think you had a pending rulemaking at the CFTC, but there's been so much that is evolving from Kalshi to Chevron. Maybe could you give us an overview as to sort of where things stand there?
So, and I'll give the 101. I'm sure there's a lot of people in the room who have been following this or understand this or know it, but not a new issue in many respects. Statutory prohibitions on certain types of derivatives contracts, and the ones you speak of, Chris, are they're binary options. They're essentially prediction markets, so that you get paid out on the outcome of an event. It could be literally the temperature in Washington today. It could be how much the Federal Reserve may or may not cut rates at a certain time at a next FOMC meeting. But in this particular instance, the subject matter, the underlying commodity, is an election, a political election. The Commission has been pretty consistent over the past 10 years about its position on these markets. We think they're against the law. There's a specific statutory section in the Commodity Exchange Act that bans certain activities: war, assassination, terrorism, gaming, anything that's not in the public interest, and anything that's illegal under state or federal law. So we've taken that position for quite some time, mostly administratively. But about a year ago, we were sued in court by Kalshi. And just about a month ago, and I'm just being rough with my dates here, a district court in D.C. ruled against us and ruled in favor of Kalshi. We subsequently appealed and requested that the D.C. Court of Appeals stay the contract, so essentially prohibit Kalshi from listing the contracts until the court reviews the issues on its merits. The appellate court denied that request for a stay, so now they're going to review the case on its merits, but meanwhile, the contracts have been listed. So actively trading on a number of exchanges right now. I said this actually yesterday. I was in New York at a number of conferences. We're going to respect the decision of the judiciary. We're going to certainly appeal it. That will take time, most likely months. But, my position, standing on that foundation of thinking that this is against the law, I also have raised policy issues about what really this means for us as an agency. And to your point about the sort of expanding scope of our responsibilities, limited resources, and really, I think it's the friction of what the CFTC was meant to do, what these markets are doing, and whether or not Congress wants us to be involved. The very simple top-line argument I've made, and I think seems to resonate with people, is that it pulls us, the CFTC, into the responsibilities of being an election cop. So if there's alleged fraud or manipulation in an election, which unfortunately we've seen those allegations seem to snowball over the past 10 years or so, and if that alleged allegation could then potentially lead to a manipulated price in the markets that we regulate, we would then have to investigate that. And we do, and we'll probably talk about this on the crypto side of the ledger, we do police underlying physical commodity markets in certain circumstances. And this would be an instance where not only we would have to investigate or surveil or examine the markets that we directly regulate, but we'd have to look into the underlying and look into whether or not there was activity, social media, allegations of a voting machine, not working appropriately. So you can imagine the number of scenarios or things or hypotheticals that might happen. And I just think from a policy perspective that is a bit too much for the CFTC as a market regulator to want to be involved in.
That's really interesting. I've said in a number of contexts when people push for any kind of regulation or the lack thereof, I always say, be careful what you wish for, because whether or not you're removing regulation or you're increasing regulation, there are always things that you may not anticipate. And what you're saying is, well, look, even if we then introduce these contracts and, even if the CFTC loses its cases, well, then the result is, well, okay, then now we're going to have to regulate them, right? And if that means that we have to regulate them, there are all these little hoops that we have to jump through, and there's going to be a new regulatory regime that would have to accompany these newly regulated products. So it's a little bit of a, do you really want that or not?
It's just one last thing, Chris. Two things, and I want to address your point about Chevron. One, it really is a matter of where Congress and where the agencies are gravitating to because of technology, right? Yeah. It's access to markets that we have never seen in history, right? It's literally an app on your phone, instantaneous purchase or sale of a financial asset, whether it's an equity, a derivative, or in this case, a binary option. On the Chevron point, I mentioned these few things in our statute that are prohibited: war, assassination, terrorism, very express and very direct and very clear. Black and white, gaming, public interest against state or federal law. And that's where in this new legal dynamic for the sort of legal folks out there, and I've been telling a lot of young law students, you go to law school, I'm sure you know this, you talk to your students as well. It's like you talk about securities law, tax law, state law, those are the corporate law. But administrative law, I mean, that's the new hot thing.
It is. And it used to be the old boring thing.
Yes,
especially as faculty were like, oh, no one wants to do that. Now it's everybody wants to do it.
And being in my shoes, I used to work in the Senate as a counsel. It's a fascinating thing about our government, the way it's set up, the three branches, and the relationship. And now with the Chevron decision, it really puts a very, very heavy onus on executive branch agencies to be very particular about what they do and what they don't do, because as we've seen, it could be challenged pretty easily.
It can be challenged easily, and the implications can end up
Huge.
Curtailing the authority of the administrative agency even more than anticipated. I mean, just one last thing, as we pivot to crypto and spot markets, I mean, as I think things through with the binary options and the election contracts, I mean, I suppose that one of the issues where you could get around Chevron is certainly when it comes to the exercise of your anti-fraud authority. I think that's where you were sort of hinting at, is that by exercising that authority and just, if people are fraudulently engaged in something that could manipulate or end up moving those binary contracts or options into a direction that they shouldn't, I suppose, well, your authority would be less constrained by any kind of Chevron-esque decision-making. But let's then move on to crypto. It will be spoken about today. Obviously, FIT 21 is still in play. You've got legislation that's still being considered. Can you give us a little bit of an update and maybe first start with the facts on the ground again, as you just did, as it pertains to the regulation of spot markets?
Yeah. So I think my response to that, some good, some bad. I think on the bad side of the ledger, maybe status quo since the time last time we spoke, probably here a year ago. We still don't have authority to regulate spot commodity markets. We still have seen a pretty robust demand for these products from retail and institutional investors. If not, that's only increased. We still are handcuffed. I use this phrase a lot in terms of what we can do. So we can't regulate, register, surveil, examine in the traditional sense. Our fiscal year 24 enforcement numbers should be coming out relatively soon. I think a bit of a decrease from the year before, and that's for no intentional reason. It ebbs and flows, but perhaps a deterrence from what was a very successful year in FY23. I think I've stated this a lot. Almost half of our enforcement docket in the previous enforcement year was crypto. That's gone down a bit, but again, it's random in some respects. So not much has changed on that side. A little bit disappointing, but we're doing our work. We're going to keep our heads down, and we'll do what we can with what we have. I think on the positive side of the ledger is a lot more momentum, and I think we've all observed this. You probably talked about it yesterday and will today. A lot more momentum in Congress, and I think just a much more robust conversation in Washington about legislation around crypto, stablecoins, blockchain technology, and credit to a number of members both on the House side and the Senate side, on the Ag Committee, the Financial Services Committee, and the Banking Committee, who seem to be engaged, seem to want to learn much more than they have in the past, and understand that this is a sustainable asset class that needs regulation. And I think time has also proven over the past 3 or 4 years that the Biden administration has been in place here, that there are gaps in regulation, right? I think there was a little bit of uncertainty around that, but I think there is a realization with the continued demand for these products and the fact that there are holes in the regulation, and we're going to need to fill them. So where that will lead us, you mentioned, I think there's still a possibility that in the lame duck, as the members come back from campaigning after the election, that FIT or otherwise might get wrapped up this year, but I would say low probability. But again, I think the positive thing is a lot of momentum, and whether or not FIT happens this year, I think the momentum going into the next Congress and a new president, a new administration for sure on either side will bode well for digital assets and fintech generally.
Yeah, it is remarkable. When that conversation on the regulation of crypto, when it started, I actually had no gray hairs in my beard, and now I have very many. Now it could just be that time of life, or it could alternatively be that getting things done in Washington has become a lot harder. When you think about how to address crypto markets from the perspective of the CFTC, there's market structure, as you mentioned. There's stablecoin issues. There are questions, obviously relating to where the regulatory perimeter should fall between all the different statutory agencies. But I'll just put that one aside for the moment. But when you think about the how to regulate crypto assets from the perspective of the CFTC, and as you've had your conversations with members and the like, if what do you think are the top maybe 2 or 3 line items where you think, here's the place to start?
Yeah, it hasn't changed in the sense that it is just traditional market regulation, and it is very distinct, as you point out, from payments, depository instruments, which tends to be more on the stable coin side. Blockchain and settlement and payments is markets in many respects, but it does raise a lot of interesting issues about what types of infrastructure, payments infrastructure we want our financial system to be built on, because that will require a significant change from where we are today. But on the market side, if I could register and oversee exchanges, brokers, introducing brokers, clearinghouses, custodians, and what does that mean, right? Registration then means information about their compliance programs, about their governance programs, about the individuals who run the company and are involved and in charge of various responsibilities. It's an understanding about their financial resource capacity, what that means in present day and on a rolling basis. It means our ability to do random examinations and surveil markets. These are, as I'm sure I've said to this event and others, these are the sort of time-tested attributes of a healthy, robust regulatory system. And in some respects, cyber, custody, and payments, I would say, just to name a few, are going to be unique in how we have to address it. DeFi is definitely an interesting layer on this argument that we have to think about, and what role does the regulator have in decentralized finance, where you don't necessarily have an individual executing, like a broker on a floor, or even in a club, or an order book like we have now. So a lot of different elements, but I think the structure and the foundation has to be built off of those same fundamentals that have served us well. And I think I've had a lot of really positive conversations with members of Congress to answer your question, let's get this base layer, to use a term that's very common here, down, and then with a little bit of flexibility and discretion to the agency, which kind of goes to Chevron, but I think is extremely important, because markets evolve and markets change. And if we as the agency, the executive branch agency, don't have flexibility, it's actually going to hurt everyone. It's going to hurt Congress, it's going to hurt us, and it's going to hurt the market. With a little bit of flexibility, we can address these outlier marginal issues to say, okay, this is a unique technology, and we have to do things a little bit different on custody or on cyber issues and sort of other matters that are unique to digital assets and fintech.
You are really bringing up one very interesting point, which is even when you look at the fit legislation or any kind of legislative package that could clear Congress, how do you make sure on the one hand that it's flexible enough for the regulators to do their job, but at the same time it's, I suppose, prescriptive enough to shield them from any kind of Chevron challenge? I mean, it's very fascinating, because I wonder, because administrative law is now the hot new thing, how does administrative law and the evolving nature of administrative law fit, to use a pun, with innovation? That's because technology is always moving, and theoretically the regulator needs to adapt alongside the technology as it's moving forward.
I think that I don't think there's a doubt that you would probably, if you surveyed members of Congress on both sides of the Capitol, they would appreciate and agree that there has to be some level of discretion, right? Because everything changes in our economy, and no matter what, you have these 3 branches, and you're going to want the executive branch to be able to adapt to changing circumstances. Yes, it feels like, and it seems like, and probably statistically, it is harder to get legislation done today than it ever has in the past, but it's always been hard to get legislation done. It's hard getting consensus among 500 plus members of Congress from different parts of the country who have different interests and different constituents. But in this particular circumstance, I actually think it even, and I've thought about this a lot in the context of Chevron and where we are today and the difficulty of legislation, and then just the velocity of change in financial markets, is that whatever I do, and whatever I introduce to the commission or think about in terms of directing the trajectory of the agency, you really have to understand what hand you're dealt and the playing field, right? And the playing field and the hand is really Congress, and it's your constituency.
And the courts.
And yes, 100%. And you just have to sort of say, okay, what's the outcome I want? And walk yourself back from that outcome. And understand and appreciate that outcome has to be reasonable, it has to be practicable, and it has to be something that you think you can get at least broad consensus on. And if you can't do that, if it's a little bit too marginal on one side or the other, political or otherwise, because it doesn't always have to be a political issue, then you're probably heading in the wrong direction. Because if you can find consensus in the middle or just among a larger group of constituencies, then I think you can work through the challenges with Chevron and otherwise. Because you're going to have people who say, oh, I don't like that. Yeah. But if it's a vast majority, then that's when you're going to run into legal challenges. And it's just a waste of time, right?
Yeah, very good. Only a couple of minutes left. AI, pretty big issue. I'm sure you've heard of it. Certainly the CFTC recently put out a request for information on AI. And, I found this pretty interesting since those who are sort of students of history and students of the agency know that, the CFTC has always been very much a technology sort of forward looking agency. What kinds of priorities do you have behind that RFI, and are there any policy developments that we should be expecting?
Yeah, AI has been a part of our markets for years. As you sort of suggested, we have actually some of the most sophisticated market players in the world. And they use derivatives for a number of reasons, speculation and hedging. So we've seen trading really evolve over the past 20 to 30 years, and AI has been a part of it. But, it seems like we're on a new precipice in terms of technology and Gen AI and large language modeling, and we have to think about what that means for us as an agency. So we put out this document. And I'm not going to rush. I've said this, and we're not going to rush into doing anything specific from the get-go. I think, as you said, it's a hot issue. It would be easy to sort of jump on it and want to have policy, but let's get feedback from stakeholders. Let's talk to Congress. Let's see what we're observing. We're a principles-based regulator, and that's very powerful, and it allows us to do a lot within the scope of what our rules are. In some respects, I can make an argument that the principles actually cover AI, right? And that we really don't have to do anything. But perhaps the other side of that argument is there are unique characteristics and distinct issues and risks associated with this new generation of AI that we may have to be a little bit more prescriptive. So the effort is, slow, be very deliberative, get information, do some inside discussions, and perhaps have policy. Everything's on the table. It could be as far as a rule, but as easy as an advisory document, and hopefully get something done by the end of the year.
Russ, it's always been a delight to talk to you.
Thanks.
Really thoughtful, interesting. It's been a delight to have these conversations.
Thanks.
Thanks so much for joining us, man.
Thanks, Chris. Appreciate it.
All right. So we're now going to get ready for our next conversation on stablecoins unshackled. Okay. See you soon.